Assalamualaikum everyone, my name is Sharizal and today I'm going to present about foreign market exchange. So the foreign market exchange, also known as Forex or FX, is the world's largest financial market where currencies are traded. Every day over $7 trillion worth of transactions take place, making it the most liquid market globally. Unlike stock markets, the forex market is decentralized, meaning there is no central exchange. Instead, trading happens electronically through a network of banks, financial institutions, corporations, and individual traders across the world. The primary purpose of this market is to facilitate international trade and investment. For example, companies use the forex market to convert currencies when buying goods from foreign countries, while investors trade currencies to profit from exchange rate fluctuation. Currencies are traded in pairs, such as the euro against the US dollars, and their values constantly change because on factors like interest rates, inflation, and geopolitical events. Major trading hubs include London, New York, and Tokyo, and the market operates 24 hours a day, 5 days a week, due to the different time zones, whether it's businesses managing foreign transactions or investors. It is looking to profit. The foreign exchange market plays a crucial role in the global economy.
Okay, good morning everyone. My name is Putra Kurshadi Izzuddin and today I will do a quick overview of the factors influencing the foreign exchange market. Okay, for the first point, which is interest rate are crucial. Like central bank, the Federal Reserve or ECB control this rate. Higher rate attract investment, boosting demand for the country currency. And next, which is inflation rate, country with a lower inflation usually have a stronger currency as their purchasing power remain higher. So, we also have economic indicator like GDP, unemployment, and consumer confidence. A strong economic performance tend to strengthen the currency as it signal of healthy economy. Political stability matters too. Countries with a stable government often see stronger currency due to the increased investor confidence. So, geopolitical event like war or natural disaster create a market uncertainty, driving people to safe haven currency like the yen or Swiss francs. Another factor is the trade balance. A country with a trade surplus tend to see demand for its currency, strengthening it, while a trade deficit can weaken it. Lastly, market sentiment and speculation play a big role. Traders react to economic news and event driving currency value up or down in the short term. To sum up all this, the foreign exchange market is driven by an economic factor, political condition, and a global event. So that's all from me. Thank you so much for listening.
Hello everyone, my name is Wanama Amza bin Abdul Ghaffar and I'm going to present about participants in the foreign exchange market. First, we have banks and financial institutions. These are the biggest players in the forex market. Banks help their customers exchange money and also trade large amounts of currency themselves. For example, if a US bank wants to buy goods from Japan, it will exchange US dollars for Japanese yen. Banks handle a lot of these kinds of transactions. Next are central banks. Like the Federal Reserve in the US or the European Central Bank, they manage a country's currency and keep it stable. For example, if a country's currency loses too much value, the central bank might step in and buy some of it to balance things out. They make sure the economy stays steady. Businesses also participate in the forex market. For instance, if a company in India wants to buy machinery from Germany, it will exchange Indian rupees for euros to pay the German company. The forex market helps businesses trade goods and services across countries. Then we have traders and speculators. These are people or companies that trade currencies to make money. They predict whether a currency will go up or down in value and trade based on their guesses. For example, if they think the euro will get stronger, they buy euros and sell other currencies to make a profit. Tourists and travelers also use the forex market. When you travel to another country, you exchange your home currency for the local one. For example, if someone from Canada visits France, they'll exchange Canadian dollars for euros to pay for things like food and souvenirs. Finally, we have governments. They might use the forex market to pay for international projects or manage their finances. For example, if a government needs to buy something from another country, it will exchange its currency for the other country's money. That's all from me. I will pass it to the next presenter.
Hi, my name is Muhammad Falik Balif and I will be presenting about trading mechanisms and instruments. The Brazilian foreign exchange market primarily operates through an over-the-counter system. This decentralized network connects banks, brokers, and other financial institutions, enabling them to conduct trades directly with each other. The OTC trading allows flexibility in contract terms such as amounts and settlements day, making it a preferred mechanism for a large-scale transaction. Moving on, we have electronic trading system platform. Modernization has led to the adoption of electronic trading platforms like those provided by financial institutions and exchanges. These platforms facilitate transparency, real-time execution, and greater accessibility, particularly for smaller trades and high-frequency trading. Electronic trading systems also provide robust tools for analytics and monitoring, enabling traders to respond quickly to market environment. Moving on to key instrument. First, we have spot transaction. Spot transaction. These are the most common type of foreign exchange transaction, involving the immediate exchange of one currency for another at a prevailing market rate. Second, we have forward contracts. These are agreements to exchange currencies at a future date at a predetermined exchange rate. Now, they are used by businesses and investors to hedge against potential losses due to unfavorable exchange rate fluctuation. Third, we have future contracts. These are standardized forward contracts traded on organized exchange. They offer more standardized and liquid way to hedge exchange rate risk compared to over-the-counter forward contracts. Lastly is option. Now, this gives the buyer the right but not the obligation to buy or sell a currency at a specific price within a certain time frame. They provide flexibility and can be used for both hedging and speculative purposes. That's all from me. Thank you.
Now we will present the regulation and market structure for the foreign exchange market. So in terms of regulation, it is in general decentralized in that there are no clearing houses that handles the transaction of currencies. However, in the national level, there may be agencies such as central banks who would define the exchange rate of their relevant currencies. So, for example, in Brazil, you have the National Monetary Council who defines the exchange rate regime. And then, in terms of the market structure, it is an over-the-counter market structure type. And in the foreign exchange market, there are three types, for example, so the spot forex market, the forward market, and the futures market. And so the participants in this market are, for example, the banks, forex dealers, investment firms, and companies. Next, I will pass to the next presenter.
Hello everyone, my name is Amir Hafiz, and let's begin by exploring the market dynamics in the foreign exchange or forex market. This is the largest and most liquid financial market in the world, influenced by several key factors. First, supply and demand forces play a crucial role. The demand for a currency is influenced by factors like trade balances and economic performance. For example, China's consistent trade surplus leads to strong demand for its currency, the yuan. Next, we have exchange rate regimes. Some countries allow their currency to float freely where market forces determine their value, while others, like Hong Kong, peg their currency to the US dollar, ensuring stability but limiting flexibility. Another dynamic is the wide range of market participation, which includes central banks, commercial banks, institutional investors, and even retail traders. For example, central banks like the European Central Bank frequently intervene to stabilize the euro in times of market market volatility. As technology continues to evolve, technological advancement has changed how trades are executed. Real-time trading platforms and algorithms trading have significantly increased the speed and efficiency of trading. However, they can also lead to volatility, as seen in the 2016 British pound flash crash, where automated trading caused drastic price movement. Lastly, geopolitical events such as elections or changes in the government policies can create significant uncertainties in the market. A recent example is the Russia and Ukraine conflict in 2022, which led to fluctuations in the Russian ruble due to the sanctions and political instability. Now, let's shift our focus to the risks involved in the foreign exchange market, which are just as important to understand for anyone participating in or analyzing the market. Exchange rate risk is the first risk. This occurs when unexpected changes in the exchange rate can affect profits or costs, especially for businesses with international exposure. For example, in 2013, the Indian rupee sharply depreciated during the US Federal Reserve's known as taper tantrum, which caused difficulties for companies holding dollar-denominated debt. Next, liquidity risk is another important factor. While the forex market is generally highly liquid, less traded currencies can face liquidity problems, making it hard to execute large trade. The Argentine peso, for instance, experiences such challenges during economic crisis. Credit risk arises from the possibility that a counterparty might fail to meet their obligations, especially in over-the-counter forex transactions. A major example of this collapse of Lehman Brothers in 2008, which caused widespread disruption in the forex market and also financial system. Operational risk comes from errors in trading systems, cyber attacks, or technical failures. A case in point is the 2019 cyber attack on the New Zealand Stock Exchange, which delayed trading activities and affected the New Zealand dollar's market performance. Political and economic risk can also greatly impact currency values. Political instability, economic crisis, or government interventions can lead to significant currency depreciations. In 2021, Turkey's political and economic stability led to the Turkish lira losing over 40% of its value, creating massive challenges for business and also investors. Lastly, leverage risk is common in forex trading, where traders use borrowed funds to magnify their positions. While this increases potential profits, it also amplifies losses. During the 2008 financial crisis, for example, many traders who use leverage to bet on the Japanese yen faced heavy loss when the yen appreciated rapidly. Understanding these risks is essential for any participant in the forex market to make informed decisions and manage potential exposure to these uncertainties effectively. That's all for me. Thank you so much.
For the conclusion part is, the foreign exchange market (Forex) is the largest and most liquid financial market in the world. With trillions of dollars traded daily, it plays a vital role in global trade and investment by enabling currency exchange across countries. Forex operates 24/7, connecting participants from around the globe, including banks, corporations, governments, and individual traders. Its high liquidity ensures efficient transactions, but it also means significant volatility, creating both profit opportunities and risk.